So good morning, everyone. Thank you for joining us this morning. I have with us Colette Powers, John, and Brad. John and Brad will be giving a presentation with us today, but first we're going to start off with an introduction from Colette. So I'll pass it over to Colette. Thank you.
Hey, thanks. Thanks, Stephanie. Hi, good morning, everybody, and welcome to all my MACNY friends out there. For those of you that don't know me, my name is Colette Powers, Powers Wealth Management at UBS, financial advisor, and I am also a certified exit planning analyst. And I am thrilled today to be able to speak to you about one of my most favorite topics is business succession. And I really, truly feel, given the events these past few months, that business owners and what we've had to navigate and the challenges, both personally and professionally, I think it's a topic that's on their mind as well. And that's why I've asked Brad Dillon from UBS and John Harubin to join me today. Both of them have vast experience in helping business owners with planning succession. So to be respectful of our time and to make sure we have time for question and answers after the presentation, I'm going to jump right in and introduce Brad. And I will give you a little bit of history about Brad before we begin. And pardon me, I'm just going to read a little bit off the sheet. I'm not being rude. So Brad earned a BA in mathematics and philosophy from Indiana University, summa cum laude, by the way, and a JD from UCLA Law School. And then he also reviewed Masters of Law in Taxation from NYU School of Law. Brad works at UBS and he helps ultra high net worth families, helping them with their tax, estate planning, and philanthropic objectives. Brad focuses on developing and implementing creative and comprehensive wealth transfer strategies that align with our clients' wishes. He reviews clients' tax and estate planning documents to ensure that they each plan accurately and holistically reflects the family's philosophy and needs while maximizing tax efficiency. So I asked Brad to join us here today to what I like to call the why now part of the presentation, because I think there are some very compelling reasons why business owners in today's environment should be considering business succession if they haven't already done so. So I ask you, Brad, why now?
Well, thank you for that introduction, Colette, and thank you for everyone who's joining on the call. This is my favorite topic to talk about as well, because 2020 happens to be the best year in history. And I know I look young, and so I've asked my older counterparts who are also formerly practicing trust and estates attorney, those who are retired, is it really, do you believe in all of your years of history too, is this really the best year in history to do estate planning? And the answer has been yes, consistently across the board. And I'm gonna tell you why that is now, today. But first I wanna just talk a little bit about how I'm gonna touch the third rail of, if you will, to allow me to talk about death and to allow me to talk about taxes and politics just for a moment, but not in a sort of a partisan way. The reason we're going to talk about those things is because they're all tied into, of course, what we've been going through this year with COVID and the pandemic. And so, you know, all of those things really have at the top of our mind, brought to the forefront of our minds, our collective consciousnesses, if you will, our own mortality. And thinking about, well, what will happen if I'm that person who gets sick, or what will happen if I'm on the ventilator, or what will happen if I pass away, or my parents, or my loved ones, or my siblings. That's all on all of our minds for the first time in a long time in a sort of collective way. And what better opportunity when it's on the forefront of our minds and our families' minds and our friends' minds to talk about it, and to really to sort of engage in this idea of, well, maybe we should get things in order just in case. And so that's where I come in as a formerly practicing trust and estates attorney, as Colette said, where, you know, just mentioning to you, getting some basic documents in place while this is all on our minds, while we're able to have these conversations with our loved ones in a real sort of concrete way for you know, first time for many of us in a long way, or in a long time. And the first of those documents, of course, is a will. And a will is going to be the place where you often will, you know, if you don't have anything in place, including for your business, if you don't have a buy-sell agreement in place or a shareholders agreement or something like that, the will is going to be the place where your assets pass through. So you want to make sure you have a will, right? So where's the business going? Or where, you know, where are my assets going? Where are my bank accounts at UBS going? Where are my, you know, my retirement accounts going, which don't pass through your will? But those kinds of things, those basic documents are going to be able to help you sort of codify your wishes, and be able to help your family think about where those assets are going to go upon your death. That's going to be really important. And the number two reason why wills are so crucial right now is that wills are often, in many states, including New York, one of the only places that you can name a guardian of your minor children. And that's going to be something that's super crucial. If you have children that are minors under the age of 18, in many states, sometimes 21 in a few states, then you're going to want to be able to talk through with your family who's going to take care of those people if, God forbid, we're the ones who get sick. Or if, God forbid, something happens to us. And so getting your will in place and getting a sense of where your business assets are going to go, or where your other assets are going to go, and then naming a guardian of your minor children if you have them, is going to help you and your family sort of be a little bit more at ease. And along with those basic documents, there's also a power of attorney and a healthcare proxy, a living will. A power of attorney is, again, this is what I was talking about before, this, God forbid, what if I'm the one on the ventilator, if you become incapacitated. It's not if you die. The power of attorney is naming an agent, a person that you trust, who's going to make decisions, financial decisions for you in the event that you become incapacitated. So who's going to keep paying your rent? Who's going to keep paying your business's bills? Who's going to keep paying your own mortgage? Or who's going to be able to, go to your bank and withdraw funds for the payment of anything? Or continue transactions that are sort of midway through. If you're in the middle of a sale of a business, who's going to continue being able to do that? A power of attorney is where you're going to be able to name an agent to continue transacting on your behalf should you become incapacitated. And the healthcare proxy living will is similar in the sense that you can name an agent, someone, again, that you trust, who's going to make healthcare decisions for you in the event that you become incapacitated. And it's sort of those really crucial decisions, those pull the plug or not decisions, right, that you have to make, which, I know I'm talking about this, in a sort of cursory way, but or flippant way, and I don't mean to. I know these are really tough decisions. And it's thinking about with your family, who's going to make those decisions, who should we name? And that's what healthcare proxy does. It allows you to name someone should you become incapacitated in the hospital. You can give that to a doctor and say, I'm the person who can decide what happens with my mother, with my brother, with my father, whomever it may be. And then a living will is where you sort of codify your wishes so that you can help that agent or the doctors sort of say, I've thought about these things in advance. I want the plug to be pulled. I don't want artificial life support. Going through those sort of, outlining in your mind what kinds of procedures you do and don't want should you become incapacitated. And those are really personal decisions that you can make with your family or on your own. And, I encourage you to take this time while we're all sitting here, sort of just collectively thinking about our mortality, that the possibility of incapacity, to really be thinking through those questions. And if you already have those documents, that's wonderful, that's great. I would encourage you to pull them out. Make sure that the people you've named are still the people you want to be named. And, oftentimes in my role, people say, no, I already have that taken care of. I've gotten it. And when I review it, I say, oh, great. It looks like you've named, Colette as your, agent for power of attorney. And they say, no, Colette, what? Or just make sure you pull those out, look through them again. And the final thing on the basic documents before I move on to the real reason about why now is the beneficiary designation. So if you have insurance, if you are life insurance, if you have retirement accounts, those don't pass by your will. They're considered non-probate assets. They pass by means of a contract outside of the will called a beneficiary designation. And so you fill out those forms. If you haven't already, if you have a UBS account with a retirement account or Fidelity or Vanguard or whatnot, they're all going to have those beneficiary designations. Make sure, again, that the people you've named are the ones you want named. Who's going to take your retirement account upon your passing? Who's going to get the life insurance money upon your passing? So those are really crucial documents. They don't pass through your will, so make sure you also check along with those. So that's just my plea, my sort of, take advantage of this opportunity while we're thinking about these things. So really get these things settled and taken care of while you can. I'm going to move on now to sort of why 2020 truly is. Besides that sort of mortality being on our collective consciousness, on our minds, why 2020 is the best year in history to do estate planning. There are 3 reasons, and I'll outline them and I'll go through them in more detail. But the 3 reasons are the exemption amount, the gift and estate tax exemption, that amount that you can give away, gift tax free during your lifetime, is at an all-time historic high this year. And it may go away next year, and we'll talk about that. Two, valuations across many asset classes are depressed. We've seen the stock market come back up, quite a bit in the last couple of months, but a lot of businesses, and this is something John will touch on, a lot of business valuations are down. It depends on what sector your business may be in, but if you believe it's down, that's actually a really good thing for transferring assets. You want to transfer them at a low value. And if you think they're going to appreciate back to their normal, sort of a normalized value, you'd love that for that to happen in somebody else's hand and not being subject to the gift or estate tax. And so we'll talk a little bit more about that. So valuations are crucial there, number two. Number three, interest rates. We've all seen interest rates have plummeted. Estate planning strategies, the sort of tried and true bread and butter strategies we use, including GRATs, grant or retained annuity trusts, sales at effective trusts, intrafamily loans, charitable trusts, all the sort of things, if you've ever heard of the more sophisticated topics, all of those things rely on interest rates. And the lower they are, the more effective the strategies. And right now we have historically low interest rates. It literally never in the history of estate planning has there been interest rates this low. And so it's an incredible opportunity. I've been calling it sort of a perfect trifecta. All these three things align: historically high exemptions, low valuations, historically low interest rates. That alignment has never occurred before in such an incredible way. And that's what I've been talking to my colleagues, my former colleagues, my retired colleagues, and saying, has there really never been a time like this? And it is, categorically the answer has been, it has never been a better opportunity. So I'll touch back on the gift and estate tax exemption amount. Right now, it's $11.58 million that any individual can give away during their lifetime without being subject to the gift tax. Normally, if you exceed that amount, you're going to have to pay, suppose you give away that amount and then I decide to go and give Colette $1 million. I'm going to give Colette $1 million, but I have to come up with $400,000, 40% tax, gift tax, to pay to the government in order to be able to give her that $1 million. And so we get, before we're subject to the 40% tax, we get $11.5 million about to give away during life, gift tax free. That amount's the highest it's ever been. It's set to continue going up until the end of 2025. That was a negotiation under the Tax Cuts and Jobs Act. However, and I've written an article about this that came out last week, I really believe that as the prospects for Democrats rise in both the Senate and the White House, we've seen that a lot of the Democratic politicians have advocated for lowering that exemption amount, that way that you can give that amount you can give away during life, from $11.5 million to $3.5 million, a 70% decline. We haven't seen those amounts in over a decade be that low. And so that's going to really curtail a lot of planning strategies, because it lowers that amount. And that's not a political statement. It's a factual statement about what the Democrats have proposed. Most Democrats have proposed a $3.5 million exemption. Joe Biden hasn't actually proposed anything as far as an exact dollar amount. However, a majority of the Democratic senators who have proposed something have proposed $3.5 million. It seems to be sort of where their minds are at as an appropriate amount for an exemption. So we're seeing that as potentially as something that could happen, as soon as next year, if the Senate turns blue and the White House is taken over by a Democrat as well. And because the House is already Democratic, and obtaining a Republican majority there looks very difficult given the number of seats they'd have to obtain. So the reason I'm talking about politics here and touching that sort of third rail for now is because it's so crucial that this year we have these exemption amounts, this amount to give away, to plan with, to give to a trust for the benefit of our kids, to use our business interests to make gifts of partial interest in our businesses to trust that benefits our kids, that utilize that exemption amount by making large enough gifts to do so. And this year might be the last opportunity in history to do it with to such a degree. And a lot of people, the most common retort I get from people is, well, yeah, but the Democrats, even if they come into office, they're not going to get their act together to pass massive tax reform legislation until sometime, late next year or whatever, right? So maybe September, October, November of next year. Well, there's nothing, and this is what my article is about, there's nothing in the Constitution or in Supreme Court jurisprudence that forbids them from making that tax legislation retroactive to January 1st, 2021. And so that's really important here, because we're living in a period of certainty for the next almost 6 months until December 31st, 2020. Starting January 1st, we don't know. We suddenly, we don't know what our tax rates are going to be. We don't know what our, how the exemption amount's going to change, how the estate and gift tax laws are going to change. Joe Biden has proposed eliminating a step up in basis on capital gains. He's proposed, increasing the capital gains rate from 20% to an ordinary rate of 37 or 39.6% of the new rate next year. We don't know what those rates are going to be because Congress is going to take some time first to come into office, mid-January, but then actually get together and form tax reform to actually write the actual laws and have the Joint Committee on Taxation review the budgetary rules and all of those things, get that together and to be able to do it till mid-time next year. But it doesn't matter because they can make those laws retroactive. And in fact, they've done it in the past. There is a precedent for making tax laws retroactive, particularly in years where there seems to be a real strong need for tax revenue. What have we done? We've just spent trillions and trillions of dollars on massive pieces of legislation, which I think hopefully has helped a huge number of businesses, maybe many of yours, through those PPP loans and EIDL loans and other tax provisions there. But we have to pay for that somehow. And I think there's going to be a sense of urgency next year about how to do that. And so my sense is there could be a stronger case for making tax legislation next year retroactive. So instead of applying it to the following year, applying it to the year in effect. So I think that's going to be a real key issue next year. So that's just a ploy to create, instill in you all the sense of urgency that these exemption amounts, again, that amount you can give away during life. We have about a little bit less than 6 months of the year, right? 5.5 months left of the year where we know with certainty what we can do and how we can plan. And it goes beyond that. I mean, with the proposals of raising the capital gains rate, I think we're going to see a lot of people wanting to sell their businesses before the potential capital gains rate is increased by such a large amount. A lot of people are going to play a wait and see approach and see how things go and maybe look into maybe come August, September, does it look bad? Who should I talk to? But I encourage you to start thinking about those considerations now. While you have the time, because 5.5 months is not a lot of time to plan. And so, talk to your advisors now. Moving on to the second part, the valuations being depressed across many asset classes and why that's a really good thing. I just wrote an article for UBS. It's coming out next week in a magazine from the business owner segment. And the title of it is 2020 is the best year ever, ... to do estate planning. And because it's obviously a terrible year, but for many reasons, not least of which many businesses are suffering. And that means the values of their businesses have really declined. And I think John's going to touch on this much more than I will, but the value of those businesses has declined. But that's, again, a really good thing for estate planning. Creating a trust for the benefit of your family right now, say, and transferring assets into that trust while the values are low, while the exemptions are high and the values are low, you get to leverage that exemption, use more of it, or you get more assets out of your estate and into, for example, a trust that benefits your family. And the reason you want those values low is because you want them to appreciate outside of your own name, so outside of your own estate. I am also an adjunct professor at Fordham Law School where I teach trust and estates. And the thing I tell my students there is the number one tool in an estate planner's toolbox is getting assets out of your estate as soon as possible. And the reason is because you want the appreciation to happen not in your name, but in someone else's name, in a trust name or someone other family member's name, so that when you die and the tax man or woman comes along and tallies up everything that you own at your death, it's a smaller pool of assets because they're going to take 40% of that federally, 40% of that at your death. So you want that pot of assets to be much, much smaller. What better way than to get some of those assets and get them out of your name by making gifts? And that I'll tell you, you can go pay someone $800 an hour, but that's the number one thing they're going to tell you. The number one tool in our toolbox is get assets out of your name now. And business interests are incredible assets to do it with, because in many times when you don't have a publicly traded company and it's privately held, you can get a discount for valuation for lack of marketability, lack of control when you give a minority interest in your business to a trust that benefits your kids or to your family or your descendants. And that can be a huge boon. So while you have $11.5 million or over 23 million if you're a married couple to give away. You can actually give away substantially more if you have a business, because you can give away a chunk of it and get it valued at something less than, one, because valuations are down for a lot of businesses right now, but two, because you get those valuation discounts when you go get it valued by an appraiser for saying, hey, you know what? My business isn't publicly traded. It's harder to sell on a market. So give me a discount to value. And two, I'm giving away a minority interest. So it's going to be hard for who wants to buy a privately held business interest in something that they don't, in an interest that isn't really even a controlling interest. You don't really have a say over how the company is going to be managed because you just have a minority interest. And that's what you want to do, because you're going to get a discount for lack of marketability too. So those discounts can be 30 to 40% of on a discount of the fair market value, which means that you're getting $100 of stock in for only $60 to $70 of gift tax value, of eating into that gift tax exemption amount. So you can leverage that in an incredible way. And now is the time to do it. And business interests are a really wonderful opportunity to use that for. And then the third reason that I mentioned before for the why it's the best year in history to do estate planning ever is that interest rates are at an all-time low. And I just want to talk about, the IRS every single month they release a rate that they assume assets are going to appreciate at every single month. So right now, I'll tell you, in July, and as was the case in June, the rate that they assume assets will appreciate at if you buy or fund an asset this month in June or in July is 0.6%. So the IRS has to come up with this amount, right? For various reasons. They have to assume if you invest in something, we have to assume a rate of return on that investment for various reasons. That assumed rate of return on any investment that you begin in July, they assume is 0.6%. That's really, really, really low, the lowest it's ever been. And it's really wonderful because most assets, we believe, hopefully, are going to appreciate at some rate greater than 0.6%. And the only reason that matters here is because most of the estate planning strategies, the tried and true, the bread and butter that we know and love, for example, GRATs, Grant or Retained Annuity Trust, they rely on getting the appreciation out of your estate, the appreciation of an asset out of your estate, the business interest out of your estate. But if the IRS is assuming it's growing at 0.6%, that's all they care about for gift tax purposes. If it grows at a rate beyond 0.6%, that extra appreciation amount is going to be able to go gift tax free to the beneficiaries of your choosing. And so if your assets return 5%, 4.5% of that effectively is going to go gift tax free to the beneficiaries of your choosing. And that's the case just for a grant or retained annuity trust, but across so many of the strategies. Again, these aren't aggressive strategies. They're going to cause you to get audited on a return of some sort. These are tried and true, known, loved, tested in the Internal Revenue Code itself strategies that we rely on a day-to-day basis for estate planning. And those interest rates are embedded in every single one of those strategies. And when they're so low, these strategies are so much more effective. So those are sort of the three reasons that I think that 2020 is the best year ever in history to do estate planning. And I think I hope all of you out there listening, if you have a business yourself, if you have friends with business or clients with businesses, that you talk about this or think this through. Now is the time, and we don't have a ton of opportunity left, right? We have 5.5 months left of certainty to utilize these very, very, very favorable rules that are written into the code itself. And I know the number one retort I get from business owners is always like, well, I don't want to give up control of my assets, and I don't want to give away too much of my assets. And what if I live too long? What if I need that money ultimately? What if I need those assets back? Those are common retorts, and we have plans and strategies and ways to deal and make you feel at ease and comfort with all of them. For example, a lot of people say, well, $11.5 million is so much money. I don't want to give away that much. Why only have X number of dollars? So, but the idea is to give away as much as you possibly can feel comfortable with. But in order to be able to get that back, say you made a mistake, you have donor's remorse instead of buyer's remorse. You gave away too much money, and say in 5 years from now, another event happens and you really need those funds. There are ways to potentially get those assets back. One way is just to include a spouse as a beneficiary. If you're married and you're in a successfully long-term marriage, including a spouse as a beneficiary is a great way to just put you at ease to say, well, if something happened, we needed those funds, the trustee could make a distribution to my spouse, and that would be back in the family pool. We could use those assets again. So there are ways to get around that. The control issues, again, ways to get around that. Choosing trustees that are going to help you make those business decisions, that are going to listen to you, help make those business decisions, both the shares and in the way that you want. We have known tried and true strategies and to deal with those, to put you at ease and comfort. And if you're thinking, oh, still feeling icky about it or whatnot, then pick up the phone and call us. You know, we can walk through your specific situation and make sure that, you know, we can put you at ease, that, you know, because right now it is truly an opportune time to take advantage of this moment in history and plan. So with that, I think I'll turn it back over to you, Colette.
Okay. Well, thank you so much, Brad. That was really, really, really informative. Next, I'd like to introduce to you John Harubin. John manages client transactions for EdgePoint. And just so you know, I think I mentioned it before, EdgePoint is one of our UBS, one of our M&A partners. Okay. And he leads business development initiatives and provides leadership for the EdgePoint team. He leverages his technical and business experience to identify and advise companies contemplating ownership transition through a sale, acquisition, or a management buyout. He has a proven track record of delivering creative and innovative solutions to middle market businesses with a focus on entrepreneurs and closely held family enterprises. I asked John to join us today to discuss what I now like to call, you know, what's next. So should a business owner, if he or she is contemplating a succession, what would be some of the steps that they would have to take to prepare? So I'll ask you that, John, and I'll let you answer the question.
Great, thank you, Colette. And I think the bulk of my presentation will do a lot of that, I hope. Yeah, I appreciate the opportunity to be with everyone today. I have, I've told you this too, Colette, a long affinity and fond memories of both Central and Western Upstate New York. Over the last 20 years, we have represented and worked with companies from Buffalo, Rochester, Fisher, Binghamton, Albany. We're currently working with a company in Saratoga Springs, and so have worked and you know, got to know a lot of really good business owners in that area. Secondly, I've made a direct investment in the area, is that I have a son who graduated a couple of years ago from RIT. So many a ride on the toll road, or sitting there hoping it doesn't snow while he's driving back to school from Ohio, and that's where we're based, is in Cleveland, Ohio. And then also have some dear friends from Ohio who 50 years ago moved to Skaneateles, and we visited a number of times over the years and enjoyed being up there. So appreciate the chance to be with you today. I'm going to, and Stephanie, I'm going to ask you to help here to make sure I'm not nearly as an engaging a speaker as Brad is, but I'm going to actually go through some slides. I found that you know, doing these Zoom calls like this, while I'm talking, you can keep an eye on those slides. Maybe if you got to check an email or something on your phone, you'll be able to do that. But I think some of the things I'll go over in my slides will answer the question that Colette asked about, very specifically, you know, business owners that are at this point of planning. You know, they've sat down with someone like Brad and Colette, and they're figuring out what their next step's going to be and what's next. For ones that possibly selling their business is going to be one of those strategies. You know, I'm going to go over what some of the current environment that we're seeing could impact value, and helping them figure out the timing of that decision. So what I'm going to go over is sometimes a full day seminar. So as I said yesterday when we were prepping for the call, I don't want to give everyone the sensation of sipping water from a fire hose. So I'll you know, some of these things I'm going to go over in very lightly, but you know, there's a lot more details below it, but at least it should give you an idea of some of the things you should be considering, or at least contemplating while you're doing this. So I'm going to go over, I'm going to get the slides start or get the presentation started up here. Go to share screen.
And John, your PowerPoint presentation, I did get a version of a PDF that can be sent to attendees, correct?
Yes.
Perfect. Awesome. So the people that are here, you'll receive John's PowerPoint via PDF after this presentation this morning.
I hit screen one.
Yep. Just the first one. Yep.
First one. And then get my PowerPoint up here. Is that working?
Perfect. Yep. And then now you'll pull up your PowerPoint.
Hang on, I think I have to move it over here.
Yeah, you should just be able to pull it up from the minimized.
Yeah, but I've got it on another screen, so I'm trying to move.
Ah, gotta drag it over. I know I got two here, but I use my laptop for the webinars. It can get a little tricky.
Let me try this. Sorry about that.
Yeah, you might have to pull it over.
There.
Perfect. Yes, perfect.
Okay.
Yep.
And then slideshow.
And start from beginning.
All right. Is that okay, Stephanie? Can people see that?
Yeah, so you might have to move it over just a little bit more to do the start from beginning. Like the whole thing itself, just so you can click on the part. You know how you can like drag over the, like from the top on the orange? We can see it, it's just pulled up in your PowerPoint.
I can't get over to the top, over to that slide.
That's okay. If you just want to make it a little bit bigger,
Do that.
yep, that's perfect. That
Better,
works.
okay.
Yep, looks great.
Sorry, I'm at my age, I'm techno challenged, but anyways, we'll get started. I wanted to tell you a little bit about background about us, just so you have some context about, where, some of our insights on this are coming from. As I said, we're based in Cleveland, 28-person firm. Most of what we do, as Colette said, is sell-side representation. So that's owners that are looking to potentially sell to a competitor, to private equity, a family office, maybe employees might be involved, key employees or management. Anytime money and ownership are going to change hands, that's typically what we do. We've been doing this since 2000 as our firm. We represent, as Colette said, mostly family-held businesses and entrepreneur-founded and led businesses. So the issues that those folks, owners like that look at are different than, and a lot of us have worked in much larger environments. If you're helping a publicly traded company or, companies, just below that size, the issues they're looking at are different than, owners of those type of the family-held businesses and entrepreneur-led businesses. And I'll get into that a little bit too. So for us, again, that's middle market focus. Everyone identifies that differently. For us, though, it's generally companies, say 5 to a couple $100 million in revenue. Most of what we look at is sub $50 million in revenue, and we work across the country. So we have clients actually internationally. So we have clients from California to Connecticut to Texas and Florida. So we're talking to lots of people in lots of places, as we go along and do this. The areas we focus on, given we started here in Cleveland, Great Lakes area, we have a strong industrial manufacturing practice. So as you can imagine, there's a lot of metal bending and machining and fabrication and chemicals and things that go on, in the Great Lakes area. So we have a lot of experience in there. Consumer products group. It's a lot of food and beverage, a lot of packaging, different types of products there. You could see business services could include distribution, services related around any of these sectors, actually. We have a healthcare group, and we have a group that works a lot in the energy space, power generation, oil and gas, utilities, alternatives. So those are the kind of the 4 areas where we, or 5 areas where we see most of our work. We're basically, as we always say, we're kind of blue collar Midwest folks. Very simple. We try and take a simple approach. Our clients, like things simplified too. So when someone comes to us and they said, hey, we're thinking about, possibly a liquidity event, selling our business, we just take a step back, roll up our sleeves and say, well, there's 3 things we want to see that exist before we think that might be the case. And, one is the business ready, is the owner ready, and is the market ready? And those are those circles you see there. When there's some alignment, they're all critical. We'll talk a little bit about how we look at those, but they're all critical in this analysis. So, some areas might be more ready than others, but when we see some level of alignment in that, we think is when it's a good time, layered in with the other planning for owners to sell their business. For the first leg of that stool, if you will, is the owner ready? Brad and Colette, talk about, there's a lot of personal reasons, financial planning reasons, wealth planning reasons, estate planning reasons to look at this. By the time we're having this conversation about a potential sale, there's a number of things that seem to repeat themselves with us. And we average about 15 transactions a year. We've done probably getting close to 300 transactions, over the last 20 years. And we see certain themes emerge, fairly consistently in the situations we deal with. Entrepreneurs and family businesses typically, we find, care about their employees. Employees in a lot of instances, if it's a multi-generational business, they as part of their, are they ready assessment, say, I want to make sure, I could do something to potentially take care of my employees, keep my employees in the business, or keep the business, in this community. That kind of layers over to the bottom left bubble. There is legacy, family. If my mom and dad or family started, or grandpa started the business, we want that name and legacy to continue. Entrepreneurs are typically, confidentiality is usually very important. But, really the linchpin, if not first, oftentimes second in this assessment of whether the owner's ready, is they want to look at, I also want to get the best value or the highest price. So this is where, again, in contrast to Brad, when you're doing some estate planning, you want the lowest price possible to achieve some of the goals and objectives you have on that side of the fence. When it comes to creating a liquidity event and needing the maximum amount of money, we're looking to maximize that value. So, and there's planning that can kind of thread the needle on that, as you go through this process and prepare for it. Underpinning a lot of these is emotion, which you don't get. We've represented General Electric and a lot of bigger companies, here, and then in other areas of our careers. And one thing that's missing when you're working with companies like that we see a lot more is emotion. There's a lot of emotional factors that go into, assessing, what are these priorities, and, is the owner ready? We're working with a situation now where, we started speaking with a dad who started a business 50 years ago. Unfortunately, he passed away during the process. A son who was tangentially involved in the business jumped in, hadn't really spoken with his dad about what the plan was when something happened to dad. So the son jumped in to try and run the business. It's a multi-state business. His mother, turned out, they didn't do a lot of great planning. The mom, who had nothing to do with the business, is trustee of a trust. The other kids not active in the business are beneficiaries, and nephews are working in the business. So grandma wants her grandkids employed. Because of the sort of lack of planning and lack of communication early, which I know Colette and Brad will echo, is the sooner you start having these hard conversations, the more likely it is you're going to get to a destination that's going to meet what you want to be. So our job in assessing if the owner's ready, and aligning all these goals and objectives is to make sure, that through planning and communication that, people can still have Thanksgiving together and walk away happy at the end, at least not for business reasons. If they do, it won't be because of business reasons. Second leg of the stools I'm talking about here is, is the business ready? And, there's on this pie chart, there's a number of factors we'll look at or consider when determining whether a business is ready. Brad mentioned there's a lot of sort of legal and tax things that, excuse me, we'll look at in assessing that. It's a little bit like selling a house, a little bit. You want to look at what's the business look like? Is there staging and things we can do to help that? A lot of make it more attractive and more valuable if you're looking for higher price, to potential buyers. And some of those things are, we see entrepreneurs like, you got to clean up inventory. Owners are very resourceful. We'll walk into facilities and the owner never throws anything out. There's piles of machines around, and they know there's parts in that pile that they can use to fix other things, and that's great. But we'll tell them to have a garage sale and try and extract that kind of stuff. We get questions about, should I buy that new machine, that new $1 million machine? Should I buy that new processing line? Should I hire a COO or a general manager? So, again, much like when you're selling a house, do you want to remodel your kitchen and your bath right before you move? Are you going to get your value out if you do that? So as part of that, is the business ready? We'll take on the operational side, we'll take a look and see, what are those things that would be necessary and you can see value, and what are ones that you might want to defer and depending on who the buyer is, partner with them to achieve those goals. So we'll look at all those, this part of the puzzle, but assuming that this part of the puzzle works too, and we're in good shape, the financials, I'll talk about those in a little bit, but assuming that aspect is good, the next set of this is, is the market ready? And, I've been telling people in the olden days, like in January, this was the least, this was the best part of that puzzle. Like the market had been really good since, say 2010, 2011, as the recession, as we started to come out of the Great Recession, the M&A market for most businesses has been at peak activity and peak level. Valuation, we've seen a lot of activity out there, prior to, this COVID and the pandemic coming on. So valuation, for that period or previously, and even now to some extent, as we know, this is going to be the largest single event. It's an emotional event, but so determining this value is going to be critical. So the metric for determining value, and I kind of walk through this here, is that one of the common financial metrics, or the most common financial metric for determining value, is the acronym. Some of you are probably familiar with it, is EBITDA, and it's an acronym for earnings before interest, taxes, depreciation, and amortization. And buyers, in taking, looking at some sophisticated valuation metrics, they want to get a return on their investment. And EBITDA to them, they might say, we'll pay, and I just have an example in there, 5 to 7 times EBITDA. So if your EBITDA is, for example, is $1 million, they would pay between $5 and $7 million for the company. And EBITDA, something, it's a bit of an art on our part in figuring out what that is. To us, a lot of entrepreneurs, manage their books to avoid taxes. So we always say EBITDA is kind of what you would, what would your earnings look like if you didn't have to pay taxes? So there's a lot of discretionary, there might be some personal expenses running through there. We find, there might be family employees on the payroll that if someone else owned the company, they wouldn't, necessarily have to incur that expense. So again, contrary to what Brad talked about in minimizing value, we're trying to show the maximum amount of profitability and cash that a company's generating with that EBITDA number. And in most instances, that's based on, a trailing 12-month calculation of what that EBITDA is. There's some instances where it could be a multiple of revenue or sales. Some instances it could be for cyclical businesses, it might be the average of multiple years of that EBITDA. But if you think about, buyers are going to look backwards to the last 12 months, calculate what that EBITDA number is, put a valuation multiple on it. Obviously for most businesses, this, the pandemic is going to, likely negatively impact that that calculation. So values are going to be, impacted by that. And part of it is, and I have there on the bottom, buyers are looking for steady, predictable, recurring, and growing EBITDA. They want that trend, and companies that can show that trend or demonstrate that trend are going to be rewarded in value. So, but buyers are savvy, and again, if they see, the opportunity to because of this situation, if the last 12 months are lower, they're going to question the predictability and recurrence of revenue. They consider that a big risk, and for risk, they're going to penalize you on value. Size matters just generally for EBITDA. That multiple range will be different by industry, and it'll also be different by size. So companies that have $2 million of adjusted profit, that's sort of a first break point for a lot of companies. There's a buyer universe that likes that size and pays them a certain multiple. When you get to $5 million of EBITDA, the multiples expand. So that signals to the market you're bigger, you're more profitable, obviously, and there might be more growth. So a buyer, to increase their return, is willing generally to pay a little bit more. And then when you get up to $10 million, it's that's another one. But we're going to talk about next about how do you get that highest price. If you look at a range of value, and if you're 6 to 8 times of EBITDA, a couple $1 million or $1 million between a 6 times or 8 times is or the difference between $2 to $6 million, and that could meaningfully impact your financial plan and your wealth plan and your estate plan. Some of the things that Brad was talking about. So kind of triangulating and figuring out what your EBITDA is and what your value is based on that is is very important as part of that discussion. Next up, I have here just sort of the top 10. Given the volume of activity we see, currently and over the years, we've talked to thousands and thousands of buyers. So we start over time, you start to see patterns and questions. And these are, probably 10 of the most common things we see. And I say this is pre-COVID. We'll talk about how this has changed a little bit with the pandemic. But, for companies that possessed, some amount of these attributes that we have listed here below, those are the ones that tend to get, the higher range of a value. So if it's a 5 to 7 or a 6 to 8 times value, the more of these attributes here that a company or your company would possesses, the better it is for us to be able to advocate to the buyer that you need to pay the higher end of that range to maximize value. Just to kind of walk through some of these for you. Excuse me. Growth. If you can demonstrate or talk about, where there's opportunities to grow geographically, product expansion, pricing. There's just a lot of areas. If you can talk about that, buyers like that because that's going to increase their return on investment. Acquisitions. This has become even more important today, given there's companies that have struggled because of the pandemic. We're working with clients that know some competitors and folks in their industry that might be struggling through this. And they may possess, again, customers or products or geographies that could be attractive. So either potentially acquiring them before you sell or identifying them as potential acquisitions to a buyer, is good. Predictable revenue, recurring revenue is kind of in the industry what they talk about. You're not project-based. Unfortunately, construction is a project-based, but there are instances where there's recurring construction projects, but buyers like to see that there's some recurrence or repeatable revenue. Long-term contracts. those don't really exist as much anymore. But what we look for and what we advocate is for sticky relationships. No one enters into 10-year contracts with someone, but most everything seems to be cancelable on 30 days notice. But if you could say, I've done work with, again, just GE or some company for 20 years, and year by year, we work with multiple people there, that demonstrates that stickiness, that it's a repeatable or a strong relationship. So long-term contracts or relationships. Leadership, strong management team. A lot of owners, if every decision has to run through them, they can't take a 2-week vacation. They're on the phone constantly. So owners that have delegated responsibility and don't have their finger in every single decision in the business, that's a qualitative factor we can advocate that would demonstrate value. And again, if you take it from a buyer's perspective, if something happens to that owner, they get hit by the bus. We sold a bus company once, and the owner said that was a real possibility. The business goes away, and that's a risk to a buyer. So they're going to pay less for a business where that risk exists. So that management team, long-term employees or strong employee base. Most people, business owners we talk to, we say, what keeps you up at night? And I would say across the country we hear, I can't find enough good employees. So if you have a good employee base, a loyal employee base, that's valuable these days, because a lot of buyers can't replace that. They can't move it somewhere else. They can't, they consider that they want to, make those people happy. So that's another attribute. Proprietary products, if you have anything patented, trademarked, that's helpful. Defensible niche, if you have if there's any licensing or certifications that would make it difficult for someone to replicate the business, that is another good attribute. Another big one is low customer concentration. So if you have any one customer greater than 20%, or a couple customers that are 60% of your business, buyers see that as a risk. And we saw this through the Great Recession. If a customer leaves, a lot of the business could go away. So that's, again, from a buyer standpoint, a huge risk. So we're seeing people look to diversify their customer base so that, they don't have all their eggs in one basket, if you will, from a customer standpoint. Quality data. Some companies don't borrow, so they don't get audited financials. Not every company should have, needs audited financials, but, having good books and records and things that tie out really well, having a, controller, even a CFO level person that has their arms around the numbers can be very helpful, going forward. And then self-serving from our standpoint, but we have so many stories out there where, the last point here is competition. Hiring an investment banker or somebody to represent you, to speak to multiple buyers, to create competition, to drive up value. Again, back to our house analogy, if you're in a great neighborhood and you take the first offer that walks in, are you going to go to sleep saying, maybe if I held out a little more, I could have done better. So a competitive process we found again and again in many instances could yield much higher value. So those are the 10 things we think owners, some combination of those, the more the better, will help you get to that, both pre-COVID and today. I guess back to the what now and why now, Colette. Again, I said that what's good now is there's still tons of money out there. I mean, you see different numbers. I hear literally trillions of dollars of buyers. And I think overall the economy was not, there weren't the fundamental problems with the economy that there were back in the Great Recession. So that money has kind of stayed put. They said the pandemic and, is kind of a extraordinary event that doesn't hurt the economy or long-term won't hurt the economy so as much. So there's still a lot of buyers out there looking to do deals. So that the activity is still good. Other than some sectors, like I said, automotive, energy has been down. There's been a big slowdown in since the pandemic. So there's some things that I'll talk about here in a minute that we're seeing. There's sort of some green shoots where things are happening, but most businesses have been on, some sort of pause as they were catching their breath and getting their feet under them with this. So, the third bullet I talk about, buyers want predictability and they want a return on their investment. So given the slowdown that most businesses have experienced during this time, buyers are going to be very skeptical of the sustainability of EBITDA going forward. So owners might say, we're going to get through this by September or October. Buyers aren't necessarily going to take their word for it until they're able to, until they can see it in the performance. So because of that, they're going to look to adjust either the EBITDA range or what multiple they would pay, likely down in most instances based on the future impact of any businesses they might acquire. So for us, knowing what the future holds for owners and doing some work to know your projections, know what's coming to the extent you can, is going to be helpful. So what should an owner do today based on this? We initially, this was somewhat of a joke that was going around on the internet with folks in our industry, but what we're seeing and we know is going to happen, and we're dealing with it now, is that EBITDA analysis is going to be adjusted to the acronym EBITDAC. And so they're adding a C to the end, and that's going to represent the, sort of the one-time impact to cash flow that the pandemic has caused. And being able to show that, it was temporary, or it was, one time, is probably an owner's best defense to, try and maintain or get back to a value that would have been pre-COVID. Owners that are able to, demonstrate that, and they were prepared to weather this storm, as some were, they're going to be, in a great position or better position, once we get to the other side of this. One thing we're seeing as part of a process, if any of you have talked about this with someone or your CPA or even your attorneys, there's something called a quality of earnings that's becoming a standard practice for a business to determine value. And people say, well, CPA firms prepare this. They'll say, well, I get an audit every year. Isn't that good enough? Well, why these quality of earnings are going to be increasingly more important going forward is that an audit tells you where the business performance was on a given date. This quality of earnings helps validate the adjustments for EBITDA and what's been happening to the business, over a period of time, so that if you're looking back 12 months and trying to show, what the pandemic impact was or was not over that time, this will give kind of a real-time validation to, that EBITDA earnings to buyers, give them comfort, help them, our job to help convince them that, their risk is not as bad as it might be. And some of the questions that owners are going to get, as part of that and being able to talk about, validate this is, they're going to say, what was the disruption to your supply chain? Obviously the last couple of years, there's been, tariff issues, before the pandemic that have impacted, the flow of goods around the world from an international standpoint. So, we found businesses have been benefited in COVID by a made in America, emphasis. So, we had companies that didn't have any Asian suppliers, and folks are flocking to them during this time. They're actually performing better during this time than maybe some of their competitors that were relying on, some Asian supply chains. How impacted were your customers or your suppliers and your vendors, as part of COVID? How did that, how did the pandemic impact that? How impacted was your industry? Obviously, oil and gas and energy, that was impacted separately of the pandemic, but there's other industries. If you're in restaurant, obviously that's been devastating in a lot of regards. So there, knowing where your industry impact is or has been will help help maintain value. And then what costs might an owner have incurred to get through this time, that were specifically pandemic related? Were there remote working costs you had to incur, systems? Did you have to replace or outsource some suppliers or vendors or processes that had been done elsewhere previously? Those could be adjustments to that, to EBITDA, to make it EBITDAC, and help us get to that maximum value number. So I think the punchline of this this part of it is that businesses that can demonstrate capability, this capability to show this EBITDAC, and have gotten through this, they're going to stand out when they come to market, and those are the ones that are going to be in the best position to get a premium value in today's market. And that's the last sort of formal slide I had. Colette, I hope that answered to some extent why now. We're seeing, I'll say we are seeing activity. Every week of the last 6 weeks, we've seen more activity. Again, there's so many more buyers out there than money sitting out there that people are actually looking at a number of things, and we're seeing things get done, and people are getting their feet back under them. And obviously there's a new flare up in the pandemic, but once we get to the other side of it, which I believe we will, we're anticipating the second half of the year to be as active. I know there's going to be election impact to it, but we're anticipating things will continue to be robust.
Yeah, I agree, John. I think business owners too, just from a personal perspective, right? If you were 2 to 3 years out, perhaps, of considering selling your business, I mean, I think the pandemic has maybe pushed that timeline up. I know for my husband, who was home for 3 months, who said, I'll work till the day I die. He's like, you know what? I think I could retire. So I do think there's going to be a lot of activity along those lines, and business owners are really going to be taking a look. And that's why, hence, I really wanted to have this conversation, because, if you can afford to do it and you know what your number is, right? And the opportunity came along, and good planning and good opportunity to work with someone, would you do it? So you have to really kind of know what your number is, right? It starts with that. I always say that to business owners, what's your number? So I'll let you, Stephanie, are you going to open it up for question and answers?
If anyone has any questions, Brad, I think you answered a question we had in the chat previously, correct?
Well, I'm seeing it in about my investment accounts have beneficiaries listed. Does destination will trump a listed beneficiary? So your investment accounts themselves likely won't have a beneficiary designation, but oftentimes, for example, the way it's held, like if you hold an investment account as joint tenants with rights of survivorship, then that's going to pass automatically and not under your will. So that's going to be an automatic. When you die, it automatically goes to your spouse. Your will is not going to take control there. Oftentimes you might have some sort of designation, but for the vast majority of accounts that aren't joint accounts, those are going to pass by operation of your will. And so having your will in place and who's named there is going to be really crucial. A lot of times people get around that by naming a joint owner of that account, and that's when you can pass outside of the will. But those are separate from contractual sort of beneficiary designation forms that you see in a retirement plan account or a life insurance contract, where those do always pass outside of a will, whether you have a joint, you're married or not. So again, I just encourage you to reach out to your advisor and double check, where is this going upon my death? Does it pass by operation of my will? Or if you have questions, I'm always here to answer those questions too.
Brad, I actually do have a question for you. I'm a beneficiary for my brother. I recently got that a couple of years ago. But for a young professional, in your opinion, what age do you think a young professional should start seriously thinking about their will?
I mean, that's a great question. I think there's not too early of an age, because if you think about it, if you don't have a will, I live in New York. So New York State, if I didn't have a will, New York State has a will for me. They've decided where my assets will go on my death for me. So, if you don't know what those rules are or those laws are, and by the way, those can change at the whim of any new, legislation that's passed in your state Congress. So, having a will is just codifying, solidifying what you want. And I used to, when I was a practicing attorney, I volunteered at a place here called the Gay Men's Health Crisis, where I drafted wills, powers of attorney, healthcare proxies for people living with AIDS. And a lot of times, oftentimes those people couldn't afford to go to a lawyer and have their wills drafted. And so I would draft those wills for them. Those people would often leave their posters on their walls to people, right? They just wanted to know, these are the things of sentimental value to me, and I want them to going to these people. That comfort knowing that, okay, you don't need to have wealth to have a will. It just gives you that comfort of knowing, like, I have a couple things that I'm not wealthy, but I have a couple things I'd want to go to this person or that person. A will does that for you. It gives you that comfort of knowing it. And, these days with some online services, wills, whatever, LegalZoom, things like that, you can do some really cheap options if you don't have assets. If you have a lot of assets, I would definitely recommend hiring a sophisticated attorney. But if you are, just want to pass some items of furniture, a couple pieces of jewelry or something like that, I would definitely say a will. The second you become an adult is there's no early time that's too early.
Pretty much. I don't have any other questions in the question and answer or in the chat right now. We don't have anything.
I have a question for John. I was just curious. Have you seen any surprises in how owners have reacted to the pandemic with regards to considering a sale?
Yeah, well, there's been owner surprises where we're amazed at the amount of people that, again, this was a shock to the economic system, but there's a lot of owners that say, you know what, they're confident we're going to get through this. And, for the ones that got through the recession and are getting through this, are saying, I don't want to go through this again. I don't know what the next thing's going to be, but I'm very interested in planning. So Brad, hopefully your word's getting out there to folks, and they're becoming more incented to, talk about this and be better prepared to make a move afterwards. I think from a surprise, Colette, from a business standpoint, it's hard to paint the whole economy with a broad brush. I've heard recently I know we have automotive prior to this, we were selling about as many cars as we were pre-recession, but because of the pandemic, we have some people making parts for boats and pleasure craft, and that market, because of COVID,
is crazy right now.
Boats are off the charts. We have a client that we're working with that sells countertops through Home Depot, like granite countertops, and we thought, that's going to come to a screeching halt.
No.
And what we found is that, and he had a customer concentration, 50% through Home Depot, and what we've seen is that people working at home, sitting at their dining room table and looking at their kitchen counter every day, say, you know what, I'm getting sick of that. I'd like to,
Right.
So they had a better April this year than they did last year. So there's some weird dynamics going on out there. We have people in the food world that do food distribution. If you're doing it to grocery stores, things are great. If you're doing it for restaurants, you're in trouble. So it's again, you see where where you're fitting in.
And Brad, one more question for you I had is, because we talked about the potential tax ramifications in the election, right? So there's always a lot of times this, well, let me wait and see, right? But as you said, it's November. So what do you say to that, to someone who's considering that kind of approach?
Yeah, great question. I've been out here for a lot since the CARES Act came out the end of March, telling people about all the tax benefits under the CARES Act, the PPP loans. But then I always added, and by the way, estate planning is going to be a crucial topic this year, I guarantee you. And here we are. PPP loans have settled down a lot. The CARES Act, we've entered this new normal. The first few months, I think, were triage mode. Everyone's sort of just pulling everything together, trying to figure out how to get to the next day. And now that we've sort of entered this new normal where there's a little relative, at least, calm, I think people can finally start focusing on estate planning. But a lot of the retort I often hear, so I'm glad you brought this up, is I'm just going to wait and see what happens in November. If Joe Biden and the Democrats take over the Senate and the White House, then great. I will, start doing the things you've been telling me to do. Get my, utilize the exemption, make gifts, take advantage of the low interest rates, etc. But I'm telling you is, in even my history, in 2012 we had a fiscal cliff. November and December were the busiest years, or the busiest months ever for estate planning then. And I'm still cleaning up the messes of estate planning lawyers hastily drafting things at the end of that year. It's
Wow.
still 2020. And so my comment back to people who say I'm going to wait and see the results of the election before I start planning is good luck, because I was speaking to an estate planning lawyer yesterday who said that he's going to start turning down clients he doesn't know personally, because they're starting to get so overwhelmed already, right? And I mean, imagine as the months proceed, particularly if Democrats' prospects continue to rise in the polls, I think that estate planning lawyers are going to be overwhelmed and profoundly busy, especially come November and December. If you call up an estate planning lawyer the day after the election, I guarantee you that number is going to be busy. I'm going to get a busy signal, right? And so don't wait. And to effectuate a sophisticated estate planning, a sophisticated estate plan, you need more than just an estate planning lawyer. You need your accountant on board, and you need valuation experts, particularly when you have business interests. Getting that sort of cadre of advisors together to effectuate in a sophisticated estate plan is going to be nearly impossible for the last 7 weeks of the year. So I encourage you, if you want to take that wait and see approach, wait till August or September, right? See what the polls are doing, kind of take a pulse, or at least get everything in order so that you can pull the trigger the day after the election, right? And so I think we're going to see a lot of movement in estate planning world, and in John's world. I think, as the prospects rise for Democrats, and we see, particularly even yesterday with Joe Biden's $2 trillion environmental plan, which, great plan. It's going to require an increase in taxes. And so, and whether you feel like that's a political benefit or not, or something we need, it's still the reality is if you have a business, I think that's going to affect buyers and sellers. If they believe that in 2021, capital gains rates are going to be, 50 or 70% higher than they are now, it's going to cause a lot of movement in the market. So I do think the last 5.5 months of this year are going to be extremely busy. So all of you on the webinar who are listening to this now and who have the means, the ability to sort of, if there's relative calm in your business's life cycle right now, take advantage of that opportunity to get your planning in order and think about whether or not a sale is in your imminent future or not, because it's these last 5.5 months of the year are going to be a race.
Great, thank you. Well, I just want to thank you, Brad, and thank you, John, for coming and joining us here today. I think all of you know, I said my passion is about business succession. I live with a business owner. I know what a family business is like, and I know what we know we're supposed to do and what we don't do, right? And then it's these stories like you talked about earlier, John, with the father and the son. And so please, I just hope today that we provided you with the knowledge and the framework and the motivation, right? If you feel that stir, right? It's known like 48 hours after a seminar, you say, oh yeah, what was that again? So if you really, you forget it. So if you really, really are feeling that stir, I really, really plead you to, give a call, start talking to the people. We're here to help. And I hope you found it very useful and informational today. So
thank you all.
Thank you.
Thank you all very much. I'm glad you all attended this morning, and I hope you all have a nice day. Thank you.